Want to start investing but don't know where to begin? Don't worry, I've got you covered. In this video, I'll reveal the secrets of successful investors and show you how you can start growing your wealth with as little as $10. That's right, you don't need to be rich to start investing. We'll break down complex topics into easy-to-understand steps so you can start building a brighter financial future for yourself. All right, let's talk about one of the biggest secrets in the investing world: compound interest. This concept might sound complex, but it's actually quite simple and incredibly powerful. Albert Einstein even called it the eighth wonder of the world, and for good reason. He understood that compound interest can turn modest savings into substantial wealth over time. It's the snowball effect of earning interest on your interest, and it's the key to building real wealth over time. Imagine a snowball rolling down a hill, gathering more snow and growing larger as it goes. That's how your money can grow with compound interest. Let me give you an example. Imagine you invest just $100 every single month, and let's say you get an average return of 10% per year. It might not seem like much at first, but the results over time are astonishing. Now you might think, that's not a lot of money. But hold on, because this is where the magic happens. The power of compound interest lies in its ability to grow your money exponentially. Over 30 years, that consistent $100 a month, thanks to the power of compound interest, would grow to over $200,000. That's right, your small monthly investments can lead to a significant nest egg. That's the difference between having a comfortable retirement and struggling to make ends meet. The earlier you start investing, the more time your money has to grow, and the more secure your financial future will be. If you had just saved that same $100 a month without investing, you'd only have about $36,000. While saving is important, investing allows your money to work for you. See the difference? Compound interest is your best friend when it comes to building wealth, so the earlier you start, the better. Don't wait. Start investing today and let the power of compound interest work its magic for you. Now, let's talk about another crucial principle in investing: diversification. Diversification is a strategy that can help you manage risk and potentially enhance returns over time. It's a fundamental concept that every investor should understand and implement in their investment journey. You've probably heard the saying, "Don't put all your eggs in one basket." This age-old adage is especially relevant when it comes to investing. Well, the same goes for your money. By spreading your investments across various assets, you can protect yourself from significant losses. Diversification is all about spreading your investments across different asset classes to reduce risk. This means not putting all your money into one type of investment, but rather spreading it out across stocks, bonds, real estate, and other assets. Think of it like this. If one investment goes down, you don't want your entire portfolio to tank. By having a mix of investments, you can cushion the blow if one of them performs poorly. So what are some of the best assets for beginners to diversify with? It's important to start with investments that are easy to understand and manage. Index funds and ETFs, like those tracking the S&P 500 or the NASDAQ, are a great place to start. These funds allow you to invest in a broad range of companies with a single purchase. They give you instant diversification by investing in hundreds of different companies. This way, you're not overly reliant on the performance of any single company. Dividend stocks are another solid option. These stocks not only have the potential to appreciate in value, but also provide regular income through dividends. These are companies like Apple or Coca-Cola that pay you a portion of their profits just for holding their stock. This can be a great way to generate passive income. It's like getting paid to own a piece of the company. Over time, these dividends can add up and significantly boost your overall returns. And of course, we can't forget about real estate. Real estate investments can provide a steady stream of income and potential for long-term growth. Owning rental properties or investing in REITs, real estate investment trusts, can provide you with passive income and long-term appreciation. Real estate can be a great way to diversify beyond traditional stocks and bonds. Remember, diversification is key to building a resilient portfolio that can weather market storms. By spreading your investments across different asset classes, you can reduce risk and increase your chances of achieving your financial goals. One of the biggest misconceptions about investing is that you need a ton of money to get started. But that's simply not true. You can start investing with just a few bucks. Seriously, There are tons of apps out there like Trading 212, eToro, and Robinhood that let you buy fractional shares of stocks and ETFs with as little as $10. The key is to start small and invest consistently. Remember compound interest? The more time you give your money to grow, the more powerful it becomes. A great strategy for beginners is dollar cost averaging, or DCA. This means investing a fixed amount of money at regular intervals, like every week or month, regardless of what the market is doing. DCA helps you avoid emotional trading and ensures you're buying more shares when prices are low and fewer shares when prices are high. Remember, time in the market beats timing the market. Now let's talk about risk and reward. In the world of investing, there's a direct correlation between the two. Higher returns usually come with higher risk. But don't let that scare you away. Smart investors understand how to manage risk effectively. Different asset classes have different risk profiles. For example, bonds are generally considered low-risk investments, as are ETFs and dividend stocks. Growth stocks, on the other hand, have the potential for higher returns, but they also come with more volatility. Real estate falls somewhere in the middle, offering a good balance of risk and reward. And then you have high-risk assets like cryptocurrencies, startups, and speculative investments. These can offer the potential for massive returns, but they can also result in significant losses. The key is to find the right balance of risk and reward based on your individual goals, time horizon, and risk tolerance. If you're just starting out, it's generally a good idea to lean towards lower risk investments and gradually increase your risk exposure as you gain more experience and confidence. Chapter 5. Avoid these common investing mistakes. Don't fall into these traps. Even the smartest people make mistakes, and investing is no exception. It's easy to get caught up in the excitement or fear that comes with market fluctuations. In fact, many beginners lose money because they fall into common traps. These traps can be avoided with a bit of knowledge and discipline. But don't worry, I'm here to help you avoid them. With the right strategies, you can navigate the market with confidence. One of the biggest mistakes is trying to time the market. Many think they can predict the perfect moments to buy and sell. It's tempting to try to buy low and sell high, but even professional investors struggle to do this consistently. The market is unpredictable and can change rapidly. Instead of trying to predict the market, focus on long-term growth and stick to your investment plan. Consistency and patience are key. Another common mistake is investing in hype stocks without doing your research. These stocks often seem like a sure thing, but can be very risky. Just because everyone is talking about a particular stock doesn't mean it's a good investment. Popularity doesn't guarantee success. Always do your due diligence, understand the company's financials, and make sure the investment aligns with your overall strategy. Research is your best friend in investing. And finally, avoid panic selling during market dips. It's natural to feel anxious when you see your investments losing value. The market goes up and down, it's completely normal. These fluctuations are part of the investment journey. Selling your investments when prices are down locks in your losses. It's important to stay the course and not let fear dictate your decisions. Remember, stay calm, stick to your plan, and ride out the storm. Your future self will thank you for your patience and discipline. Chapter 6. Bonus Secret. Building a strong portfolio for long-term growth. Want a ready-to-go investment strategy that you can start using today? Here's a simple yet effective portfolio allocation for beginners looking for long-term growth. Start by allocating 50% of your portfolio to ETFs that track the S&P 500 and the NASDAQ. This will give you broad exposure to the US stock market and a solid foundation for growth. Next, allocate 30% to dividend stocks. Look for established companies with a history of paying dividends like Apple, Johnson & Johnson, or Procter & Gamble. Then allocate 10% to real estate. You can invest in REITs or even consider buying a rental property if that aligns with your goals. Finally, set aside 10% for higher risk investments. This could include cryptocurrencies, AI stocks, or startups. Remember, this is just a starting point. You can adjust the allocation based on your risk tolerance, time horizon, and financial goals. Chapter 7. Conclusion plus call to action. So there you have it. The secrets to successful investing are out. Remember, investing is a journey, not a get-rich-quick scheme. Start small, invest consistently, diversify your portfolio, and stay disciplined. Now I want to hear from you. Which of these secrets resonated with you the most? Let me know in the comments below. And don't forget to like this video and subscribe to my channel for more investing tips and tricks. Oh, and be sure to check out the description for links to the recommended investment platforms we talked about today. Thanks for watching, and I'll see you in the next video. eToro, start building your financial future today. Hey guys, it's Alexander. Listen, I know that investing can seem intimidating at first, but trust me, it doesn't have to be. The most important step is to just start. Even if you can only invest $10 a week, that's $10 more than you had before. And over time, those small contributions can add up to something truly significant. Remember, the name of the game is to build wealth over the long term, so don't get caught up in the day-to-day fluctuations of the market. Stay focused, stay disciplined, and you'll be amazed at what you can achieve.